So, thanks for being here this morning, everyone. I do appreciate it, and we're going to kick off this kind of a basics class on long put options. And by the way, we're just talking about long put options. We did long call options last time, and now we're doing the long put options. And this is a straight up directional strategy. Now, we had talked before how basically a stock trade has been split into two: call options and put options. Half of the trade, the bullish side of a stock trade, is kind of wrapped up in the call option. The bearish side of the trade is wrapped up in the put options. So it's kind of a split 50-50 of the stock itself. And it's really important that you get some of these basics down if you ever want to expand on your training and options. So I thought this was a pretty good quote to kind of relate to the possibility of shorting the market. Okay. We all know that the market, for some reason, as traders, we all kind of inherently understand the idea of buy low, sell high. It kind of makes sense. We buy something cheaper, it advances in price, and we make money. The other side of that seems to be a lot more difficult to get your head around, and that is buying something or shorting something by buying it higher and having it go down. Well, with a put option, you can avoid the complication of short selling. Is anybody in here ever been a short seller? Where you physically have to put on the short trade, you borrow the shares from the broker loans you those shares, they're immediately sold out on the market, and then you owe the broker these shares. And consequently, that process can be a little bit complex, and it's a little bit difficult to understand. It requires a margin account because you're actually short. If you've ever heard the term buy to cover means that you have to buy the stock back to return your shares that you borrowed from the broker back to the broker, and you hopefully sweep out the profits in doing that. Okay, well, you don't have to have that complication with a put option strategy. A put option strategy, we can take advantage of a downside move in the market without all the complication of actually shorting. And what most folks don't know or don't understand is that there's really no difference between a call option and a put option except for the direction that you're trying to trade. Okay, they're almost identical strategies. Now, if you look at a put option P&L graph, this can be kind of confusing. I know P&L graphs on options were always confusing to me when I first looked at them, because they didn't seem to follow the method of a standard graph. Okay, because in a way this seems backwards to me, right? In a call option, in a call option graph, it makes sense. If I were to draw that call option graph, it would look something like that. Okay, we kind of understand the idea that we buy it low and we sell it high, right? That's what we want in a call option graph. We want to, it just kind of makes sense. But when we look at a put option graph, it seems kind of backwards, doesn't it? Because we're buying that put option and it's showing us this upslope. Okay, and this is where our profit comes. Well, I think it would be better descriptive for a lot of people and easier to understand if the put option graph actually looked like that. But that's not how the math works out. That's not how it works out for a trade, because we're wanting the stock to move towards zero. Okay, and the way the graphs are set up, we have profits here and losses here. So when we buy that put option, It's virtually identical to the call option in the sense that it has a limited risk. A long put option trade has a maximum risk of what you put into the trade. So if you spend $3.25, okay, 325 to buy a put option, that's your maximum risk, $3.25 a share, or $325. Okay. The other thing that was always confusing to me, and I struggled with this for quite a while when I was learning options, is that they always, and you notice I didn't put it on here, but they'll always tend to put something in here that your break even has to come to a certain price. So your entry here, you have to get to here for break even. Has that ever confused you guys? Who wants to buy a position that it takes, the stock has to move quite a ways before you break even? Well, what they're trying to show you in that graph is that to recover your $3.25, the stock has to move down so that you're a break even. Okay. Now they don't do that with a stock. That's why it doesn't make any sense to most people. When you buy a stock, they don't show a P&L graph that says you've got to recover $5,000 to break even. Right? But they do that on option graphs all the time, and it's really confusing to a lot of people. There's really, it's no different buying a put option and knowing that your risk in this trade is $325 with a single contract. Your $325 is at risk, and if the stock moves down, you don't have to worry so much about break even, because if this moves up to $425, you've made $100. Are you concerned about the break even that it has to move that full 325? No, we're about making profits, right? And it's the same in a stock. You don't worry about recovering your entire position in the trade on a break-even graph. Okay, so if that's ever been confusing, hopefully that'll help you with that. But this is basically what we're looking for in a trade. Buying a put option contract is considered a long position. That's also very confusing for a lot of folks, because we're buying a long position, taking advantage of a short move in the stock. So it gets transposed all the time where people will say, well, I'm shorting the stock. Okay, or I'm shorting this position. But what they really are doing is taking a long position going short. Now, I know if you're brand new to options, that's like, well, you stand there for a while and pound your head against the wall because you just can't get it. It just doesn't make sense. But just remember that when you buy a position, anytime you buy an option, okay, you buy a call option, you buy a put option, it has a maximum risk of what you pay for the contract. And when you buy a position, you are considered long that position. Okay, so the buyer is considered long, and as the buyer, you're also considered to be the holder of that. You'll see that terminology a lot. You're the holder of that position. Now, obviously, the objective with a put option is we want to see the stock moving lower. We want to see that price action pushing that stock down. That's how we get those option values to go up on the put side. So buyers of options are called holders, and they acquire rights and they have a long position. So even if you're going, thinking about the downside of a trade and trying to short a stock, okay, by buying a put option, you are in a long position. Because we have paid a premium for this, we have acquired rights. Okay, whenever you pay a premium for a position, you acquire rights. That right is a contract that says you have the right to either to pick up that position on the contract if you want to, or you have no obligation to do so. You can just get rid of the contract to collect your profit. So what does that mean? That means you have the right to exercise, meaning you can, with a put option, you've got a right to sell the stock at a specific price. So if you have a right to sell a stock at $50 a share and the stock falls to $45 a share, you have a profit in that trade, right? Because you bought it high, you sold it high and you buy it back lower, right? You have the right to sell it at 50. It's now at 45. You just made $5 a share. Okay. So that put option gives you that right to sell the contract or right to sell the stock at a specific price within a specific period of time, but you have no obligation to do so. You do not have to exercise that contract. You can simply close that trade or sell that position back to whoever in the market is going to buy that. Sell that position back to collect your gain. Okay. Anybody confused on that? I don't want to belabor the point if everyone understands that, but if there's someone here that doesn't understand that, please, like I said, getting the foundation of this stuff is really important. Okay. So you have the right, anytime you own a contract, you purchase a contract, you have the right to sell that option to either collect your profits or to stop a loss. Okay? Maximum profit in a long put is if the stock drops all the way to zero. In a call option, we say that there's an unlimited upside potential. Theoretically, a stock has no limit as to how high it can go in price. But obviously, a stock can only fall to zero. So there is technically a limit to how far a stock can go to the downside. It can only go to zero. So there is a limit, but obviously, depending on where the stock is, that could be a huge potential profit in that position. The maximum loss in a put option that you've purchased is the premium that you've paid. So again, if you've paid $3.50 a share, the maximum you can lose is $3.50 a share. You cannot lose more than that. Okay? So I'm going to blow through this pretty quickly. If you guys have questions on this, stop me. But moneyness is, it's always seemed like a funny word. It's like it's a made up word for options. But an in the money put option, okay, is above the current stock price. An at the money option is obviously right there, very, very close to the current stock price. In the out of the money option, the contract would be below the current stock price. So in the money, at the money, out of the money. And we always want to trade the in the money contracts. We want to be in the money on any directional trade. We'll talk about that in just a second. So intrinsic value of a put option is the amount that the option is in the money. So if we have a stock, okay, that we sold at $50 a share, we bought a contract at $50 a share, and the stock is now at $40 a share, your intrinsic value in this option is $10. Okay? Any additional cost that's on that trade is considered the extrinsic value. That's your time value of the option. So if you look in your option price is actually $12.20 on that option, we know we have $10 in intrinsic value. That means we have $2.20 of extrinsic value or time value in that option. Okay. Now, Extrinsic value, we talk about this quite a bit. And by the way, if you guys are still struggling with these kind of concepts, there are classes on the members webpage or the members website that we cover this stuff pretty extensively. So if you're still fuzzy on these topics, please make sure and do that additional study. Take it on yourself to understand it, and never feel bad about reviewing or asking those questions, because I can tell you, when I was new to options, these concepts were very, very difficult for me to pick up. I had to go back and review them and review them and review them and review them until it finally kind of cemented and it kind of clicked for me. So never feel like you're asking a dumb question, or that you're struggling to understand it. Hey, that's okay. I know people that have traded options for a long, long time still struggle with this. Rick has made a tremendous profit this year in his trading. When I talk to him about these kind of things, it just almost makes him mad after a little bit. He's like, all right, we're done. Because it just bends your head so much sometimes, you can't quite get it. And so you have to take it in pieces, and you have to keep chunking away at it until it finally clicks for you. Now, the Greeks, also, we're going to glaze over this stuff really, really quickly. The Greeks, if you don't understand them, there's more than one class on the web page, the members page, on a fully detailed class on the Greeks. So make sure you review that if you don't understand the Greeks. Delta, we always focus on Delta here in RightWhy, because Delta is so crucial to our positioning in a trade. Delta is the amount that the option is expected to move based on a $1 change in the underlying stock. Okay, it's the same for a call option that you buy and a put option that you buy. If you buy a call option at $3 a share, the stock moves $1. If the delta is a 75 delta, that means that your $3 purchase should be at a minimum of $3.75 a share. Okay, because it's going to move. It's the speed at which an option value will change prices. Okay, they call it the speed of change. All right, delta is also a probability of how the option is calculated mathematically, how it will, the probability that it will still be in the money, have some value at expiration, the probability that will still be in there. So if we have a 75 delta put option, we have a 75% probability that that option will still be in the money at expiration. Okay. Gamma. Gamma is considered, you'll hear it said a lot of times, it's the delta of the delta. If delta is the speed of change, gamma is the acceleration, how fast an option can accelerate in value. Now, gamma is one of those very difficult things. It's kind of like that double-edged sword. A high gamma can be great if you're exactly right on direction. A high gamma is a disaster if you are not right on direction. So gamma is really, really important, and that comes into the placement, why we buy the options that we buy. We'll talk about that in a second, but it's the amount that the delta will change based on a $1 price of the underlying stock. So I mentioned if we had a 75 delta, oh, darn it, if we have a 75 delta option, okay, we have a 75 delta option that we buy at $3. All right. If the stock moves in our direction, we're thinking put options here today. So if the stock moves down $1, we know that this option should be worth a minimum of $3.75. Okay, based on the delta. But if the gamma happens to be 10 cents, Okay, we're going to pick up a portion of that 10 cents in this premium as well. So that means this could be as high as $3.85, because that is telling us the speed of change of our delta, how quickly our delta will accelerate in value. Okay. Theta is our time decay. Theta tells us how much extrinsic value we have in an option and how much decay is going on in that extrinsic value. So, for example, if we have a theta decay rate, you'll always see those listed as something like we have a 5-cent theta. That's telling us that mathematically this should decay in value. If all else stays the same, the option should decay in value by 5 cents a day. Okay. Now Vega is the amount that prices will change with a 1 point move or a 1 point change in implied volatility. This is obviously very, very important in a declining market, because in a declining market, Vega, implied volatility, rises. Okay, it gets stronger. Fear comes into the market. And that's one of the reasons why understanding put options is so critical, because we know the market has two sides. It can go up and it can go down, right? It could also go sideways. We can't really profit with directional calls or puts if it's going sideways, but both sides of the market can be covered with a long position by understanding puts. And the vega of a put option can really accelerate the profits. Okay, you've heard me say this several times, that if a stock falls, you can actually make money faster with a put option than you can a call option, because of the acceleration that's created based on that implied volatility change. Okay, now, by the way, implied volatility doesn't change, doesn't do anything with intrinsic value. The intrinsic value is never affected by the implied volatility. The implied volatility only changes extrinsic value of that option. Okay. And rho is the amount that an option value will change based on a 1% move in interest rates. This is much more important for those who use options for long term than it is for swing traders and the position traders, because there's a negligible change in our option prices over a short period of time because of a change maybe in interest rates. All right, because they're relatively quick. If you're holding leap options, however, that can be a significant thing that you have to kind of pay attention to. So the long put strategy, your stock forecast. If you're looking at a stock chart, you need to be bearish, completely bearish on that trade. Okay, there's the long put option is just straight up bearish, and there's that time element. So you just need to be right there and say, well, I think this is falling and it's going to continue to fall. So you need to have that that full-on bearish look in the chart. So if we're looking for a bearish trade, what's the first thing we want to look for in a price chart for a bearish trade? You guys that have been around a while, what do we want to see to go short a position? Downtrend. That's right. We want to see a confirming of the downtrend, failing at resistance. Thank you, Bob S. So we want to see a confirmation of downtrend, and we want to buy our put options at or near price resistance. Remember, we're buying our call options at or near price support. Put options we want to buy at or near price resistance. That gives us our lowest risk entry point. So for stock replacement, and rather than shorting the stock, I just did this quick calculation on Apple. If you were to short 100 shares of Apple, You send a short trade off to your broker loans you the shares. So there's a margin cost in it, but your cost alone going into the trade, 100 shares is going to cost you about $17,800. And not many people are willing to put that much risk in a high volatility trade when Apple is falling to put that much money into that position. However, with that put option, that one contract trade instead of $17,800 for 100 shares, you can control that same 100 shares for about $1,420. That's why people use it, and it has tremendous leverage in the position. Okay, so they pick up that big leverage. They can risk less money in the trade, but still take advantage of a tremendous profit, or have a tremendous profitable outcome if they're right on direction. Okay, so it's way cheaper, it's way easier to do than shorting a stock, and it's a little bit easier to understand for most folks. Now, keep in mind that leverage obviously is a double-edged sword. Anytime you take tremendous leverage, you have a higher percentage risk on the wrong side of the trade, and on the right side of the trade, a higher percentage potential gain. So kind of keep that in mind. And that's one of the reasons why we're very picky about where we enter those trades, because the leverage can really cause us problems if we're not correct. Okay. Option selection. You guys know this. You hear me repeat this all the time. If we're going to buy a directional put option, I highly recommend you're buying those put options that are in the money, somewhere between around 70 to 80 deltas. Now, if you have a 69 or a 68 delta or something like that, that's the closest option contract to your 70 delta. That's not that's okay to trade. Don't get the impression that it's not. When you go above the 80 delta range, you're starting to overpay a little bit for the option, and you give up a little bit of your leverage in the trade. What tends to happen is the market makers will spread out the bid-ask spread. The closer you go to 100 deltas, they're just going to continue to spread out that bid-ask spread. So that 70 to 80 delta place tends to be the sweet spot. That tends to be where you have the least sensitivity to gamma, or a little bit less sensitivity to gamma. You have a little bit less sensitivity to theta, which gives us a really nice sweet spot to be able to take advantage of that move. So kind of remember that. And those are negative. When you buy a put option, you're picking up negative delta. Okay? Give yourself time to be right. Now, this is a little bit more challenging with put options, because we all know when a stock decides to fall, it usually just gets going and, it takes off to the downside in a big way. So timing can be a little bit wonky here. So I'm gonna tell you what my standard rules are, and then tell you how you can modify those just a little bit. One of the things that we want to do in every option trade is we want to give ourselves enough time to be right. Okay? We want to give ourselves enough time to be right. That's right, Mike. That's right. Out of the money options have very low probability of winning. And for some reason, that seems to be the focus of most option traders, because that's the cheap option. They're very high risk when they buy those, and very low opportunity of a win. When you utilize leverage, let's think about this for just a second, just off the subject here just a second. If we buy a stock trade, we're in a 50-50 position, right? From the time we enter that trade, we have a 50-50 trade. It may go up, it may go down. Now, if we're going to utilize leverage, does it make sense to utilize leverage and give yourself an even lower probability than 50-50? somebody buys an out of the money option that's, let's say it's 30 deltas on the put side, a minus 30 deltas. That option says it has only a 30% chance of being in the money, being an exercisable contract. That's what the math says. The math doesn't lie to us in these trades. So, can you make money on this? Yes, if you're exactly right on direction and timing, you can make money on them. How many of you feel that you're exactly right on direction and timing every time you enter a trade? Okay. Yeah, not often. Greg, there's a couple concepts in rolling, and we need to really cover that in a different class because there's a lot of details to understand about properly rolling a position. But what I would tell you is once you start reaching about 90 deltas in that position, so you're right on direction, you picked up that 70 delta or 75 delta option, and the stock moves just exactly like you wanted it to move. It's rolling down, okay, and it's now at around 90 deltas. That's a good time. And honestly, if you're looking at your chart, you're going to find by the time the stock moves that quickly, you're probably reaching a point of some kind of support in the chart, and you really should be thinking about scaling out or taking some profits anyway, right? As the stock moves down, we want to take some of those profits off the table. All right, so you want to scale yourself out or just simply close the trade altogether. Because you were right on direction, take your profit. Okay, put options have negative delta, Lenny. They have negative delta on put options. Call options are positive delta. Okay. So typically in trades, I want to give myself enough time to be correct in the position. And when I want to be correct in the position, I want to give myself enough time to be right. Because we've all picked up a trade. I would say you're scaling out. Dan, you don't necessarily, I'm not trying to give you a flat rule that you get out of the trade. You should be taking profits based on the price action of the chart, right? But once you start reaching into those 90 deltas, what you're going to find is the bid-ask spread starts to widen up. And that's why I said rolling a trade or doing it should be a class all in its own, because there's some intricacies in that you want to take a look at to do that properly. Okay. But just know that if you're watching the chart anyway, you roll up to about 90 deltas in a position, there's a good chance that the stock is reaching a level of support. So if we buy a put option at or near price resistance, when do we want to start taking profits or be out of a trade? We want to Okay. So try to pick up where I left off. Apologize for the interruption. So we want to give ourselves enough time to be right in a position. So what I'm usually looking for when I'm looking to get into put option trades, I want to look for enough time in a position. But I will say in a put option trade, because when stocks fall, yeah, I'm re-recording, Al. When stocks fall, they tend to move pretty darn quickly, right? So we can usually shorten up our time frame. But if we're looking for a move, let's say a 10-day or 15-day move, I'm usually always looking to add somewhere between 30 and 35 days or more to that trade idea. Okay, because we've all been in those trades where we pick up a put option and then the stock just wanders around for a week or so. Doesn't really do anything. Doesn't break our stop loss, but it doesn't move. And so you don't want to be in a situation where you've taken too short a time frame on a trade, and then you're running into a theta decay problem, and your risk is then the fact that you didn't provide yourself enough time in the trade. Okay? So you want to pay attention to how much time and how you're laying out that trade. You definitely want to plan. We talk about this all the time. This is the same quote I used in the call option trade. But, in the stock market, every time one person buys, another person sells, and both think they're right on direction. Okay, so keep that in mind. We have to have a plan in how to protect ourselves in a trade. So rules of engagement here for a put option is to never trade without a plan. We know how important that is, and I keep harping on it and will continue to harp on it as long as I can breathe and have the mental capacity to do so. I will keep harping on how important it is to trade with a plan and know exactly what it is you're doing in a trade. You need to know your entry, stop, targets, trade goals, those kind of things prior to ever entering that trade. If you're unprepared, just prepare for poor results. Simple as that. Allow yourself an edge by buying stocks or buying put options, that have liquidity. Another major mistake that people make when buying put options, when they buy call options as well, is they don't look at how much open interest there is in a trade. Make sure there's plenty of open interest in a position. Not volume, open interest. Volume tells you what's happened today. It doesn't tell you how many contracts are being held. Okay? And we've all seen stocks or options that have great big volume throughout the day, but nobody's holding those contracts overnight. High frequency trading firms move a lot of money back and forth, potentially in options. That doesn't mean that it was held overnight. So you want to make sure there's plenty of open interest. Wide spreads, just like in call options, wide spreads and put options are a red flag that there's not enough open interest, or that the volatility is so high it's creating a problem with your volatility and that extrinsic value of an option, where you're going to be overpaying for time. So watch those really wide spreads. They're that red flag that can give you a clue that, hey, something might be wrong here. I need to check just a little bit further. Always make sure you're checking those earnings dates. You will commonly see implied volatility spike during an earnings event, meaning if you're buying an option during that period of time, you're paying up a lot for that time value of a trade. You can be exactly right on direction, and if you have a volatility crush, lose on the trade. Okay, because that volatility will collapse. High implied volatility increases the price of those options, so you want to pay attention, and you need to. I need to fix that line. But you want to make sure and pay attention to that high implied volatility, because that, as a general rule, increases the price of an option, both calls and puts. This should say puts. Calls and puts, and you're paying more for time value. So kind of think about that. Now, when we're thinking about putting on a trade, I've said this a couple times already during the presentation, we want to buy a put option at or near price resistance levels. Okay. So when the stock is at or near price resistance in a downtrend, that's when we want to look at putting on one of those put option trades. And then we want to scale out or start taking profit in that trade once we're reaching those support levels in a position. Okay. Or just to take a profit. So let's look at some charts. And I'm just going to let's go to something intraday. Let's go to the Qs and just go to an intraday. And the only reason I'm going to an intraday is so that we can really look at the price action. And just, it's the same thing as a daily, but we get more occurrences, okay? And clearly we've been moving down. I'm going to go to an hourly here. We've been moving down in the market. Go to an hourly here. We've been moving down in the market over here and we've been doing that for some period of time. So I wanted to talk about the short patterns, the patterns that we want to trade. Where do we look for those short positions? Okay. So I'm going to pull this all the way back over here where we really started to fail in the market. And let's just kind of analyze on this shorter term chart. And again, the only reason I'm doing that is so I can get more occurrences of the same patterns, okay, that we're looking for. All right. So when we fail, we want to start looking for that volatility stop flipping over to red. And we're looking for those trending moves where a stock is trending down, all right? And any rally back, we trend down, any rally back at or near price resistance. Here's a price resistance that I've got marked in the chart. At or near price resistance, we want to be watching for a potential failure of that trade. So you can see if I pull this back just a little bit more to zoom that up right in here, we rallied back up, had a couple of days of a little relief rally, and then a bearish engulfing candle. Okay, that bearish engulfing candle is giving us that indication that this failure is going to continue, that we're going to move down. So if we're going to place a short trade or buy a put option, that is the time to be looking at that put option. Okay. And the reason is because we're very, very close to price resistance. So we buy that put trade, we place our stop loss right above that price resistance, and we watch this trade move lower. Now we're going to want to pay attention to the next levels of support as we move down. Just as if we're doing a long trade, we're just flipping it over where we're looking for resistance levels. We want to be looking for support levels in the places where we might want to start taking profits. Okay, but you can see this pattern remains pretty consistent. We move lower, rally back to resistance. This candle right here would be a failure, breaking that little pop out of the box pattern down, and we move on lower. So if you were entering this trade here, you happen to miss this one up here, you're entering this trade here, your stop loss goes here. Stock does move away from you, and then once again hits a price support level and starts to rally. So we want to pay attention to those levels in the chart that can start moving us in the opposite direction of where we want that trade to go. Okay. Now, another thing to point out, and since I'm showing you this on a shorter term chart, we can get that shorter term volatility to get us to cross back above. Red goes back to green on that shorter term chart. But if you're looking at this on a daily chart, this is going to stay bearish. Okay, just that hourly move here has turned that back to green. Okay, if we go to a daily chart of the same position, we're looking at October 9th when that occurred. If we go to a daily chart on October 9th, where are we at? October 9th. right there, that little bobble right there, notice that that actually was a daily chart potential short entry point because we failed through this support. There is your failure, rally back, and then failure to move us on down. Okay, so we want to be watching those price patterns as a stock fails and moves lower. And, you know, we know some stocks will just move down like crazy. Take a look at like XLE. Let's look at XLE. We know energy has not been good, right? So energy, you can see those short entry points as energy continues to fail. There's that little consolidation area. Stock continued to fall below. This was a level of support, right? And that level of support failed. And of course, we moved on lower. There's that failure of that support. Okay. So when we start looking at stocks for a short trade, my all-time favorite pattern is going to be a pattern that is called blue ice failure. And that's where we're looking at our moving averages. I don't know if I have anything that's going to qualify. Let me look real back. I'm just going to have to look back in history right here. Roku. My favorite failure pattern is right here. This is called the blue ice failure pattern. It's the flip side of the rounded bottom breakout. Okay, so let's take a look at this, and I'm going to remove all the lines and I'm going to shut off price for a second. And let's just look at the moving averages. What's going on here in the moving averages? Well, all of a sudden you see that all of our moving averages cross. Okay. We're starting to build a resistance level right in here. That resistance level is creating a problem for the stock. So we get that big move in the stock that breaks us down below that 50-day moving average. We rally back up and we run right into all of this moving average resistance here. We fail and we continue to move lower. Okay. A fellow by the name of David Elliott actually he named this, he called it actually the ice hole failure pattern. Right? It sounds kind of funny. That's why we call it in this room blue ice failure, so it doesn't get misinterpreted as to what we just said. But basically, the whole premise of this is, let's say you're walking along a frozen river and you fall through the ice. Okay, you fall through the ice and the current of the river, okay, is moving this way. So you fall through the ice, you finally bounce back up, you struggle to come back up. By the time you get back up, the hole that you fell through is right here. Bump your head and drown. Okay, the same thing happens to stocks. Obviously, they're not falling through the ice, but they're falling through that major support level. They fall through, they will struggle back. And if you think about the psychology, is why are they struggling back? Because you have a ton of people in here. Just think about the market itself. When a stock falls, if folks weren't prepared, and by and large, folks aren't prepared for this, they'll hold on to this trade. And what are they doing? They're on their knees. They're praying, man, please, oh, please come back. Please, I can't lose this much money. Please come back. And the stock will fight and struggle its way back up here because people are trying to hold on. Institutions and all of those are trying to hold on. And then when it fails right here, that's when it really sells off. Yes, the ice is the 50-day moving average, the blue ice failure. You can actually have, with my 200-day moving average, you can have a pink ice failure. You could use the 34 EMA as your failure point. Okay, but what you're looking for is that moving average pattern, that place where we fall through, we build a level of resistance. The stock rallies back and just can't make it through that, and that's where we get that failure pattern. So if we look, it's exactly the opposite of a rounded bottom breakout. What do we look for in a rounded bottom breakout? We look for that stock to break above the 50-day moving average and then pull back or hold above it and then start looking for the upside. The same thing is true on this. It's just the other side of the trade. We break down, we wait for that rally back to test that resistance, and we look for that failure. Okay. So if we take a look here, Z, yes, that is correct. Institutions are focused more on theory, focused more on fundamentals than they are on charts. You can go talk to fund managers, things like that. They couldn't read a chart to save their life. Okay. Because they're working on theory and research and fundamentals and things like that for what they do. Yeah, Kramer. Anytime I've ever seen a video of Kramer, he's got to bring someone else in to read or interpret a chart. He can't read the chart. Okay. So here we have that resistance point, that blue ice failure, that failure pattern, bearish engulfing candle right at price resistance, and that's where the real selling begins. Okay, and you can see as those moving averages continue to drop and come down, it creates resistance levels. So we move down, we finally gain some energy, we pop back up, but notice we found that resistance right there at the 34 EMA before we swept on down. Here's a pink ice failure. Okay, we rally back to that 200-day moving average, and then bearish engulfing, and we continue that failure on down. Okay. That's a very, very common pattern. It's one of my favorite shorting patterns. Now, if you take this and you put this on the volatility, with the volatility stop, what we're looking for is we want to see that volatility stop staying below the red volatility stop here. This had enough volatility in it that it went back to green. So if we incorporate that moving average in here, we can see that failure, but there's that great failure pattern. And by the way, I'm going to go back here to this chart just to be completely naked in the chart, and I'm going to remove all the lines for a second. Remember how we talked about price patterns the other day and the placement of candles and how important that placement of those candles are? Well, can you see this rally back? That rally back that came back up toward the 50-day moving average. It puts in what kind of a pattern right here? A hanging man pattern. A hanging man pattern is a warning at price resistance. There may be a problem starting to occur here. A follow through with the bearish engulfing tells us high probability sellers are going to take over and push this stock lower. Okay, so we have two signals there giving us a clue of a potential failure. Now all we have to do is put together our trade, put our stop loss in place, and allow the trade to work. It's exactly the same as taking a long position with a call option as it is with a put option. We want to buy that option that's somewhere between 70 and 80 deltas. Whoops. Why did I write it 2? 70 to 80 deltas. Okay, they're going to be negative deltas with that put option. We're going to buy that. We're going to set that stop loss so that if we're wrong, if this bearish engulfing candle does not perform for us and the stock rolls back up, we get stopped out of that trade quick. It's a low risk entry into the trade. Okay, and then we take that puppy down. Now keep in mind, because this is a put side trade, your acceleration here will be faster than any up move. It will be faster to profit, and the reason is, anybody know why? Implied volatility is going to really increase here. IV is going to increase, which means the extrinsic value of your option is going to accelerate higher. Yep, fear is very, very powerful. So that implied volatility is going to create that scare, that fear in the market and accelerate the value of that trade. And then we also know if a stock's going to fall, it's usually going to get busy and fall. When you take a look at the chart, it doesn't take long for a failure to wipe out a great big portion. So for example, August, September, October, we rallied 3 months up. How long did it take us to take all of that back? Less than a month. And then some. Okay, so fear always does that. Fear brings that move down a lot faster than that move up. So there's great money to be made on the put side of a trade. Okay, that's I'm going to see if I can find myself another chart here so to just continue to drive that point home. Here's another failure at price resistance. Okay, we drop down, rally back. See all of our price resistance right here? Now this is a pretty volatile stock. You can see it's whipping around quite a bit. Not suggesting this is one that I would have traded, but simply the fact that we're failing at price resistance and all of our indicators and candles and all of those kind of things are indicating the trouble here in the stock. And then we sink on down. Okay, rally back. There's that 34 EMA. A lower high. Notice that right here, let me get rid of all of that. Notice that right here, what this rally back was doing was testing price resistance. There's price resistance. It's testing price resistance. Okay, no failure pattern here that would have been anything I would have traded, but you can see what's happening in the chart, and it's very, very consistent. Holding downtrends in the same manner that we hold uptrends. Okay. You can see the same patterns occurring here over and over and over. Those failure points at resistance, failures at moving averages, downtrends holding in place. Those are the kind of stocks that we're looking for to short. Okay. Now, if we take this to those other charts that we have looked at before, let's just take a look at a chart like this. Now, this is right now an hourly. Let's go ahead and go to a daily. I don't know why I did that. Go to a daily, and let's pull this back on the daily, and let's go back to Roku here for a second. And you can see this moving average pattern occurs here even with that 34. Now I'm gonna remove price here for a second because I want to focus mostly on the price action of these indicators. Okay, so you can see our 8 crosses down through the 34. Our 3 crosses down, and notice how far separated it suddenly becomes right here. We get this big separation. Okay, that's an oversold condition in the short term because we get that really sharp move down. It oversells for just a little bit, and then the stock rallies back. Now, I want you to notice right here when we rally back up toward that 50-day moving average, that 34 moving average, notice that hockey stick that gets placed right here. There's that hockey stick pattern. Hockey stick in the air, showing us that failure, and we sink back down. Isn't that cool that these patterns continue to repeat themselves over and over and over? That they're all there. And you can point them out every single time. When we finally finish this up, and look at the hockey stick here on the ice. The rally point to rally this back up, to move toward that reversion to the mean before we continue to sink away. That's the common price action that we're looking for. If we look for that in the Guppy chart, okay? Let's go to the Guppy daily. You can see the same things occurring here in that chart. That failure, all of our short-term averages move through those long-term averages. Notice right here the rally back, and all of those short-term averages stay below the longer term averages, and then we sink. We get that next rally back that actually extends a little bit, but notice that how all of our long-term averages have grouped up right in here, creating, you can't see that because it's black. Right in here, all of those averages group up, creating that resistance point for that additional failure to the downside. Okay, not so good, right? If we take a look at the ribbon study and we look at Roku here on a daily, there's that green crossing over red. And that area right there is where we want to be paying attention to that potential failure. This one had that extended move here. We got just a little bit crazy in the move up. Everybody got really excited. All right, and then right back down. So keep that in mind as you're looking at these charts. Volatility can make the downside moves a little bit more challenging than the upside moves. Pay attention to resistance. Okay? Pay attention to resistance. Is Mo setting up for more downside? Looks like it to me. Now, since Mo has moved down so big, let's look right here in the bigger picture. Could there be some price support right here? Yes. So once a stock has moved so sharply down and it gets a reaction bounce back up, do you guys remember this is how a W bottom gets formed, right? We get overextended, we pop back up, we come back down and retest lows or a higher low, and that's how a bottom is formed. But yes, for the right now, for the way that looks, it does suggest it's going to have a lower low tomorrow or on Monday. Okay. I'll bet you if we look at the Guppy, it's showing how far overextended we are here. And a reversion to the mean would be not out of the question. Again, a reversion to the mean. The 8 is very far extended from that 34. So you'll want to watch that closely in this trade. But notice there's that hockey stick in the air. It's suggesting that at least Monday it moves lower. Okay. Lenny, I don't. You certainly can, looking at IV percentile and stuff like that. What I'm looking for when I'm looking at options is we know, first off, that implied volatility is skewing everything to the put side. Okay? If you guys have ever seen that on Thinkorswim, it's called the volatility smile. And my Thinkorswim crashed with everything else, so I don't have it open. But when you look at various months, there's a skew in volatility, and that skew will happen, and it will be something usually like that. Okay, the amplitude to the put side will always be higher. Okay, so when you're looking at your options in there, what we don't want to see, Lenny, is we don't want to see something, if we're going directionally short, we don't want to see a position. Let's say the average implied volatility is 25%. Okay, but we look at the option series that we're looking at and it happens to be at 60%. There's a problem. We don't know what that problem is. It might be earnings, it might be whatever it is, but we want to pay attention if the contracts we're thinking are out really far out of the norm of all of the other series. Does that make sense? Because that could be a warning for us. That could be a warning of low volume. It could be a warning of a news event coming. It could be a warning of earnings. It all depends on the stock, Ernie. You'll look at some stocks that average. They may average 45% implied volatility over all monthly series. It's just telling you that stock has more implied volatility, but 45% is pretty normal in that range. Okay, so you want to look for that range in that implied volatility and make sure that we're kind of staying in the norm. We don't want to see that odd or be buying that odd outlier. Okay. Now, if you're looking at a stock and, for example, if you're finding yourself trading the VIX and you're just really hung up on wanting to trade the VIX, just know that there's a ton of risk in just trading the VIX, because if you look at the actual VIX index, it will often have 125, 140% implied volatility, always. That means you're paying an awful lot, right? You're paying an awful lot. If you're buying those options, you're paying a lot for extrinsic value. Your time value of that trade is going to be spiking. Okay? That makes sense? So we want to pay attention to that implied volatility. We want to make sure that we're not buying something that's really, really odd in the series. Because really high implied volatility, if, like I say, if it's normally running at 25 and you see a 50 implied volatility, you better look just a little bit further. There really is no guideline for that. You have to base it because all stocks are different, right? If the VIX normally runs in the hundreds, that's normal for it. Okay, just know that when you start reaching those really high implied volatility levels, you're paying higher and higher extrinsic value, which means you have more risk if you're not exactly right on the direction and the timing. Okay, direction and timing is going to be critical. Bill, I would say your implied volatility is a little bit if a day trade only is a little bit less important than it would be for a swing trade. A swing trade, it's less important than it is for a longer term trade. However, an odd volatility can still cause you huge problems. Okay, so if you're planning a day trade, with an option, you're probably planning a very short time frame option. The option may only have 1 or 2 days left to expiration. If you buy a really high implied volatility option and the stock doesn't move, you're taking a very high risk in decay. The decay is what's going to get you. So you have to be exactly right on direction if you're trading those really high implied volatility stocks. Okay. So keep that in mind. Okay. What we want to do more than anything is we want to focus on the price action, right? Let's take a look at Mo. Now in Mo, this was a straight down move. If I were to look at this, I'm gonna go back over here to our T line. I'm gonna change this to an hourly. Were there trades that we could have had hourly on Mo? There's that boom, that big move lower. Here's the rally back to the 200-day moving average, followed by a bearish engulfing candle for a short. Our stop loss goes right there. And we move on down. We move down. What do? We hit a low and then we consolidate. We consolidate and then break that support and we continue to move lower. There's another short trade. That short trade moves down, consolidates a few more days, and then continues to fall, rallies back to price resistance of that consolidation right there. And then doji, bearish engulfing, we continue to fail. There's a short trade. We rally back, we consolidate, we fail once again. There's a short trade. Okay, so that pattern is repeating itself, and it doesn't matter the time frame. That pattern repeats itself over and over and over and over. So when we look at consolidations like this, if we look at a consolidation for a long trade, stock moves up and consolidates, we're always looking to set our alert just above that consolidation, right, to catch that trade. So if the stock pops up, we get into the position. We just have to reverse that thinking. Here's that consolidation. We place our alert underneath that support. The stock breaks through. We get short that trade. And then we follow this position down. Okay. Does that make sense? We're just simply reversing the same pattern that we used to the upside. Okay. The patterns are consistent. Can you guys see that they're always there? That the patterns are always present. If we take the time to study the price action of the chart, the patterns are always there. They're always developing. They're always giving us a clue if we look for them, if we take the time to study. This is where that really good focus time has to come in. We're bearish on the overall market. We've done our evaluation of the market. The market's bearish. I'm looking for short trades. I find Roku. I wait for this trade to set up a potential failure point. Rallies back up, kind of a shooting star type pattern, followed by a bearish engulfing. We can take that short with a low risk entry into that trade. So follow those positions. We move down. So here's that peak and valley move. Remember the two patterns that I trade. What's the two patterns that I trade? In a downtrend, move down, rally back to resistance and fail. That's the trade I'm looking for. Or we move down, we consolidate and then fail. And they're both right here. There's that push back up. There's that consolidation failure for the next move lower. The two patterns that I trade, whether it's long or short. Cool stuff. Anybody have any questions on this? So we're going to look for those on any of these. We're going to look for that in the money put option. We're going to place those stop losses and plan those trades correctly. Our stop losses, we know where the risk is if we're wrong on the trade, where to get out. And then we're going to let those put options work for us to the downside, just the way we do call options to the upside. For those of you guys that use Heikin Ashi candles, can this work for or like that Heikin Ashi? You can see the Heikin Ashi provides the same kind of patterns that it's going to provide with the trade. They're not, certainly the price action looks different. Okay, but you can see that move right here where we break down, rally back, and then fail right in here. And then we move right on lower. And there's that transition period when we start getting, with a Heikin Ashi, we start getting all of these wicks and tails. It's that transition period. We're waiting for the resumption of the downtrend or a reversal to the upside. And here we get that resumption of the downtrend right in here. And we get those strong directional moves. Notice there's no wicks on these candles indicating a strong downtrend. Okay. Yeah, a lot of people will interpret those or use that terminology, bear flag. A bearish flag, guys, is if a stock, here, let's go back to standard candlestick. A bearish flag is going to be, stock has been moving down and it rallies back. And when it rallies back up, you can kind of place a top and bottom range on that move. So when we say a bullish flag, what we're looking, the reason people call it that is this would be considered kind of the flagpole, and the flag is upside down, swinging in the wind. If you have, if I were just to draw a flagpole and put a flag out here, kind of drooping off to the side, that is a bullish flag. But we know it's never a straight line up like that, or rarely a straight line up like that. The actual flagpole will be leaning. This is just the reverse of that. So you can call them whatever you want. The pattern is still the same. So here's that flag right here. This right here, some people will call that a flag, but to me, that's more consolidation than a flag. But you can certainly call it a flag. And by the way, your pole, flag pole is here, and your flag pole is here. Okay. Just make sure you're focusing on the price action. Always focusing on the price action. One thing I will point out is if you do choose to use Heikin Ashi, notice how that smooths that chart out considerably. So volatility in a down moving market can be tough to manage, right, for a lot of folks. But you can see with the Heikin Ashi, managing the volatility of that trade down, not so hard. You may not want to use it for your entry and exit, but it's certainly good once you're in the trade to just follow that trade. Okay. One more thing before we go here that I do want to point out is when we look at these price levels, do these price levels make sense? Why are we getting... Here, I'm just going to go to a naked chart. Okay. Why are we getting these price levels? You know, besides the moving averages, is there any indication in the chart of where these things are happening? So if I draw a line across right where that failed, can you guys see that's a failure at price resistance? Okay. When this moves on down and it stops for this period of time, can you see that was a support level that we were testing? We moved down, we were testing support. Okay. The chart has logic. The price action of the chart has logic if we look for it. All right, so if you're short this position, somebody asked me about, you guys ask about how do we manage this trade? If we were going to be short here, should we be thinking about taking some dollars out of the trade right in here? Right? We want to be scaling out of that trade, taking some profits. Because we don't know when it reaches this level if it's going to come down here and just turn around and bounce. So we want to be taking some profits as we reach those support levels. Okay. Now, if we pull this back, you can see the failure of this major support. When that failed, you can see the damage, technical damage that was created in this hourly chart. We're out here in space now. We would have to go back to the higher time frames of dailies or whatever to start looking for support and resistance. If I change this to like a 4 hour, you can see that we will gain some insight into why we bounced back right into here. Why, when we fell into here, we paused for a little bit before we moved on lower. It's because of price support. Isn't that cool? To me, that is one of the coolest things about trading and about charting, because if we focus in the right place, if we focus on the chart, would you guys agree the chart is telling us what it wants to do? It's giving us clues. And we just have to look to identify that information. So in the management of your positions, if you're in a short trade, let's say you got into that hourly short trade here on that hourly failure of this support level, you're in this trade, you have to be scaling out or thinking about profits right in here, right? Because that's what the price action is telling us. We need to be thinking about pulling some of those gains out of that trade. It is one of the most exciting things to me about price action, and the thing that fascinates me still to today. I don't know. I can't tell you why this works so well, but it does. And that's all I need to know. To give you an example, when I was, anybody ever struggle with algebra when you're coming up? Some people find it real easy. Like my son is just algebra's like, well, duh, this is easy. For me is like, no, this doesn't make. And the reason is because I was trying to make sense of the equations. Okay. And I would always be asking those questions. Well, I don't understand the equation. Why do we do this? Why? And what finally got drilled into me, where I finally started figuring it out, is don't worry about the why, just learn the equation. If you learn the equation, you've got it down. Learn the equation and don't worry about the why, just do it. And then it became pretty easy. The same thing is true in price action. I don't even do the why thing anymore. When people ask me, well, why is the stock falling? It's because there's more sellers than there are buyers. That's why the stock is falling. When they ask me about the price action, why does it find support and resistance like that? I must say because it does. I don't know why, and I don't care why. What I do know is it does it consistently, and all I have to do is learn to manage that. That's all you have to do, is just trust that the chart is giving you that information. Look for the trade and it's there. Okay? So, kind of finish that up. I love price action. I love it because all of the clues, all of the things we need to trade it are being given to us if we take the time to look for it. I would have to reopen the platform. You mean as far as I can't actually place a trade, the market's closed. You're going to place a put option trade the same way you would place a call option trade. Okay, so if we're looking at get this reopened here. If we're looking at let's say we want to short Nvidia or something like that, we look at Nvidia, and instead of going to the call side, we go to the put side, and we look for something between 70 and 80 deltas. We look at our price action here. Okay, do we have a bid-ask spread that we can live with? And we look right here for our open interest. Because the open interest is at 10,600 contracts here, I would likely favor this one. But it doesn't mean that I couldn't trade this one. That's perfectly acceptable. Plenty of open interest there for that trade. So I'm just going to click the buy button. to enter that trade. Now, if you're placing this with a conditional order, the stock has to fall through a specific area. You're going to use the theoretical price model, and you're going to figure out, if the stock falls through this price, that's what this would be. Okay, so let's say we're looking at this trade, and we want to place a conditional order on the trade. We would place that conditional order based on the price action of the chart. Okay. So let's say we are at 163.47. We want to buy this trade at 163.25, meaning that the stock has to fall through a support level. Okay, so we would just pick up this trade right here, go to our conditional orders. In our conditional orders, we have to change this from a limit to a market. All entry orders are good for the day. Method is the mark, which is the center between bid and ask. We want the price to be less than or equal to, and then that 163.25. That means the stock has to fall, hit 163.25 to trigger us into that option trade. Dan, they're always going to have wider bid-ask spreads when the market is closed. At least recently, because the market makers will spread these out. Have you guys noticed you'll have a certain number when the market closes in your account? You're up $800, and then as soon as the market closes, you're up $600. That's because what's happening with the volatility of the market makers are protecting themselves, and they're opening up the bid-ask spreads at the close. So this might be a lot tighter as soon as the market opens. Okay. Good stuff. Everybody get something out of this today? It depends on the price of the stock, Dan. I mean, you can't expect a stock that's $30 in value. If it has a $30 in value, you may, and it all depends on volume too. I mean, you look at the Qs and you might be able to get 5-cent spreads because they're so highly traded. You look at an illiquid option that doesn't trade all that much, they're going to spread out that bid-ask spread. You have to evaluate it based on the price action of the chart and the chart itself. A $20 a good $20 option is likely going to have less of a spread than an option in a $400 stock like Chipotle Mexican Grill. There's going to be a wider bid-ask spread. Oh, you're welcome, Cindy. What I would recommend if you're still struggling with those, take a second and go over to on the members page in the e-learning archive. There are some classes on Delta. Well, I mean, just the Greeks. And if you look in the folder down in the bottom right-hand corner of the room, click on that folder. I think Donna put together a links page. It's right there. It's like the second one down. A links page, I think, and that's a video list, I believe. Awesome, Cindy. Awesome. Good to get practice. Practice, practice, practice. Pete, yeah, I've looked. I cannot find that article. I don't know if it's been pulled down. I don't know, but I've searched for that. I spent quite a bit of time actually searching for it. I haven't found it yet. If I find it, I will make sure and post it. Yeah, no rush, Donna. Donna does so much stuff in the background. Takes care of all this stuff. Make sure you guys get emails and notifications. Um, she works her heart out for us. So thank you, Donna, and everyone. You should really. She's the one who posts the CBOE list. She's truly the angel that keeps Rick and I on the straight and narrow. Otherwise, we're generally a hot mess. That's right. Donna keeps us on a schedule and on a plan. Rick and I have both told Donna, you just tell us what to do. You're the boss. Just tell us what to do when we're supposed to be there. Exactly. Everybody's got their own strengths and weaknesses. And I tell you what, if you ever need some help with some organizing, talk to Donna. She is one of the most organized people I have ever known. Thank you guys. Take care. I will try to get this video rendered if I'm able to recover. I think I might be able to. We'll see if I can recover that from the power loss. I'll try to get that blended back together the best I can. I will upload it to YouTube, but it will be listed as an unlisted video, and I will post the link over to the members page. So as soon as I can, I'll get that over there. You guys be safe, be careful. Yeah, we've got to be a little bit careful around here because of our storm. Who knows? It may not be as much as, they always give us these estimates, but rarely they're right. So who knows? It may not be quite as bad. So thanks for sticking around. Apologize for the power outage, but glad we were able to get back and finished up. Everyone take care. Have an awesome, awesome, awesome weekend. We'll talk to you all soon.